Global stocks have been rallying this week as investors cheered slowing inflation across major economies. Data showed US, Japan and British inflation cooled more than expected in October, thanks to a retreat in energy prices. That's supporting views that central banks may be done with raising interest rates and could shift their focus to economic growth. On Tuesday, the S&P 500 recorded its best daily performance since April as US stocks jumped with slowing inflation. The index surged 1.91%, while the Dow Jones Industrial Average climbed nearly 1.5%. According to Labor Department figures, consumer prices in the world's largest economy rose 3.2% in October, slowing from a 3.7% growth in the previous month. The figure is the smallest in more than 2 years and well below what analysts had predicted. On Wednesday, fresh data showed British inflation also slowed more than expected last month, sending European stock exchanges rallying. The annual rate of inflation fell to 4.6%, reducing the likelihood of a further hike in borrowing costs before the end of this year. In September, the Bank of England paused its historic monetary tightening campaign following 14 back-to-back interest rate increases to fight high inflation. Europe's benchmark stocks 600 surged almost 1% on the data, while the UK's FTSE 100 climbed to a near one-month high. And Asia stocks also got a boost from positive data that came out of Japan on Monday. The Bank of Japan revealed that the world's third largest economy experienced a sharper than expected slowdown in producer price gains for October, boosting views that inflationary pressures may be subsiding. The year-on-year increase in input prices for Japanese companies cooled to 0.8%, reaching the lowest level in 2 years. The slowdown was mainly driven by decreases in lumber and utilities costs compared with last year. Meanwhile, on Wednesday, China's central bank said it's ramping up its liquidity injection into its financial system by $83 billion, giving Asia-Pacific stocks a further boost. The move came after China's economy slipped back into deflation last month in a blow to economic recovery. Let's get more from senior economist Luke Bartholomew, who joins us now from London. Thank you very much for being with us today. Right, we seem to have positive news flow on the inflation front globally. What are the key drivers behind this recent inflation reduction globally? But also, are there any differences between what's happening in the EU and what's happening in the US?
Yeah, inflation has been remarkably well behaved the last couple of months. And I think what makes it really remarkable, at least in the US, is that inflation pressures are declining at the same time that US growth has been extremely strong. US GDP grew at maybe around 5% or so in the third quarter of this year. That's really strong at the best of times. And to have that growth with inflation moderating is a really impressive achievement. And it tells us that the US economy must be enjoying positive supply shocks. So supply chains unraveling, labor force participation picking up, the efficiency of labor market matching improving as well. And it's those positive supply side shocks that I think in the US case have done a large bit of the work of pushing inflation lower. Of course, the Fed's monetary policy tightening helping to keep inflation expectations well anchored. I think in the EU, it's more been a case that it's a weak economy that's helped keep inflation low. Obviously, the Eurozone looks like it's been teetering on the brink of recession for some time now, may have already entered into a formal recession, and that's economic weakness that's helping to put downward pressure on prices. And another very large part of the story is that large energy base effects. So the very large increase in energy prices we saw last year, they sort of mechanically wash out of the inflation numbers and have pushed European inflation rates much lower.
Right, and it's interesting you say inflation has been well behaved recently, whether it is in the US or in the EU for different reasons. It has been well behaved. What about the policymakers? What do they need to see, in your opinion, before they start thinking, well, we need to cut now? And when do you think this will start happening?
So I think we're definitely at the point in the cycle where the next move in interest rates for many of the major central banks will be down rather than up. Our best guess is that cutting will start in the UK, the Eurozone, and the US in around the middle of next year, all for slightly different reasons. I think for the US, what the Fed is looking for is signs that the recent strength in the economy is not going to see inflation start to pick up again. I think they do need to see growth slow a little bit before they have comfort that they can start easing policy and try to bring about the soft landing that they've been aiming for some time. I think in the UK, the crucial thing to see is wage growth moderating. Wage growth in the UK is still far too strong to be consistent with the inflation target. And I think in the Eurozone, it is just this ongoing economic weakness that will eventually see the European Central Bank cut its interest rates.
Right, there is one outlier, isn't there? China. We've seen very low inflation in China. Is this going to have any repercussions at all in the inflation trends for the rest of the world next year?
Yeah, so China has recently entered a deflation. Again, the headline rate's been sort of bouncing in and out of a negative territory for the last few months. It's been swings in pork prices that have recently pulled the headline inflation number lower. And I would probably look through those kind of dynamics. But even looking at core inflation rates in China, they are extremely low. And what that tells us is that the Chinese economy is just very weak. So in terms of the impact of that on the rest of the world, the way I think about it is that when the year started, many people thought that China was going to grow very strongly this year as it rebounded from zero COVID and those restrictions being lifted, and that could import or export inflationary pressure to the rest of the world through higher commodity prices, higher goods prices. But instead, Chinese economic weakness has meant that that sort of inflation exporting hasn't happened. So it's not so much that China's going to export its disinflation, but its weakness means that it's not instead exporting inflation to the rest of the world.
Luke Bartholomew, great analysis on inflation. Thank you very much.
Thanks very much for having me.